Good afternoon. My name is Frederick Cabanas. I'm the accounting lecturer here at LSBF Singapore, and I'm continuing my series on principles of accounts. We're now talking about Chapter 4. Chapter 4 is primarily concerned about closing out the accounting cycle, and that's done primarily with these 4 journal entries. The first thing the accountant must do is recognize that everything on the income statement is a temporary account. And as such, we need to close those accounts or make the balance 0 so that in the start of the next period, we have a clean temporary account to post the corresponding revenues and expenses. So in journal entry 1, we are actually closing out the revenue. Since revenue has a normal credit balance, to close it out, we post a debit to revenue and a credit to this temporary account called income summary. Our second journal entry is closing out the expenses. The expenses normally have a debit balance. So to close it out and make the balances equal 0, we post a credit. By posting a credit on the expenses, we then post a debit on this temporary account called income summary. At which point, we can now take the net difference or the net balance in income summary and close that amount. We would expect that income summary would have a normal credit balance because normally a business wants to make money, not lose money. So to close out the temporary account, we will post a debit. But what is the credit? The credit will be to equity on the balance sheet, to capital. The fourth journal entry is purely to clean up the balance sheet. At this point, we have closed out the income statement. The balance sheet balances, but we need to close out the temporary account of draws. We close it out to capital as well.